Okay, today I'm going to deal with the whole situation of reorganisation, and my aim of the lecture is to show ways in which a company's asset could be transferred in the most tax efficient manner to a third party. And for this example, I'm working on a situation that an individual wants to transfer a pub, which he has two pubs in a company. He wants to transfer it to his daughter in a tax efficient manner. I just want to move back one step before the reorganisation. I just want to look at a very important relief, which is transfer of business to company relief. And this is mainly for sole traders who wish to transfer their business to or incorporate their business. The relief here is a lot of people avail of it. A lot of people, when they're studying taxation, wonder what all the fuss is about on it. But really, what you're looking at a situation here is when an individual transfers assets to a company that he's after forming, that there is actually a capital gains tax event, and that's the market value of the assets being transferred from one taxpayer, which is the individual, to a second taxpayer, which is the company. Now, luckily enough, there's a very generous relief available for it, and it depends on the whole relief depends on a number of conditions. One of the conditions is that on this slide here, all of the assets have to be transferred to the company, going as far as even the just to exaggerate it a bit, into the jar of coffee in the canteen has to be transferred over. But once all the assets are transferred over, you actually you can qualify the relief. Now, the only consideration you get from the company is that you get shares. The full relief is due. But obviously, if you get a cash or deemed cash, in the case of this section, a portion of the gain will be assessable immediately. The balance of the gain is deferred. Now, when I say there, balance of the gain is deferred, it's effectively rolled over. And the way it's rolled over is that it's taken from the base cost of the shares in the company in respect of any subsequent disposal. So that's where revenue gets a pound of flesh there, in the sense that the base cost of the shares is reduced. Now, you may never sell the shares. You might just pass it on debt, in which case capital gains tax is never paid. But if you subsequently sell the shares, it'll have a reduced base cost. So effectively, revenue get the tax from the increase or enhanced gain. Cash obviously is where you're going to pay tax on it, because cash is going to be will include actual cash received by the company or non-trade creditors taken over by the company. Another factor to bear in mind is with Section 600 that it interacts with retirement relief. Bear in mind, in retirement relief, you have to be a director for 10 years, 5 years full-time. If you were a sole trader and you claim Section 600, which is a condition now to it, and you claim Section 600, well then you can take the period of which you were a sole trader in working out that 10-year requirement as a director for the company. So that's just stepping back, and let's now deal with a situation where somebody has formed a company. And we have two individuals here, Tom, and we have Dick, who's the minority shareholder, only holding 10% of the company. Tom owns 90%. The company is Alpha Limited, and it has two businesses, Pub 1 and Pub 2. The steps that are needed now is, what Tom wants to do is he wants to transfer Pub 2 to his daughter Anne. We're going to get to that in a few minutes. But the first step is that Tom possibly wants to get Dick out as a shareholder. Now, you can do that in a number of ways. Tom could buy out the shares of Dick at market value, in which case you have capital gains tax on Dick. Dick could sell the shares to another party, which that party might be unacceptable to Tom. But the most tax efficient way of this to getting around this problem is that Dick is insisting on capital gains tax treatment, obviously low rates, no universal social charge, no PRSI, etc. He wants the low rate of capital gains tax to apply. Tom doesn't want them to sell to a third party. Tom can't afford, let's say, to buy the shares off Dick. So the best bet then is to look down and look at Alpha Limited and say, could Alpha Limited buy the shares back from Dick? Effectively, could it buy back its own shares? Now, for it to do that, a number of conditions must be in place. Five of them are factual, which would be he's owned the shares for 5 years, there's been a substantial reduction in the shares, he's no longer connected with the company, he is resident, the company is resident. These are all factual situations, but the key one is Revenue will allow Alpha Limited to dip into its reserves to buy back the shares of Dick at a premium now, provided they meet the trade benefit test. And the trade benefit test is that they have to show, Alpha Limited has to show to the satisfaction of an inspector, that the buyback is for the benefit of the company's trade. Normally this is Revenue allow this in intergenerational transfers, or in the case where a certain amount of acrimony has built up between the directors, or Dick is interested in selling it, Tom can't afford it, and there's interest in bringing in another party into it that is probably not to Tom's liking. So let's assume that the company can buy back its own shares and capital gains tax applies. If capital gains tax applies, Dick is now out of the equation, and the company has used its own reserves to buy back the shares. Now we have Tom is in sole ownership of the company, and he wants to transfer. He wishes to remove Dick as a shareholder, which he's done, and he transferred one of the pubs to his daughter Anne. So they bought back their own shares, and now we have a situation that Tom has sole control of Alpha Limited with Pub 1 and Pub 2. Now, if Tom arranged for Alpha Limited to transfer Pub 2 directly to Anne, what we have the situation there is it will be a disastrous tax consequences there, because first of all we'll have a capital gains tax event at the level of Alpha Limited. So Alpha Limited is going to have to pay capital gains tax on the enhanced value of that pub. Second of all is, if the asset is transferred to Anne, well then, if Anne has not paid full market value for it, you're going to have a situation of a distribution, transfer of asset at undervalue, and it will be deemed to be in the transfer of value of an asset at undervalue to Tom, in which case it will be deemed to be a Schedule F assessment on Tom. Now that would be at the top rates for all USC, etc. So that's not a very tax efficient way of doing it. The best way of doing it, and the most common way of doing it now, is that Tom forms a new co and transfer Pub 2 to the new co. Now if you just look at this structure here on this slide, you have Alpha Limited owned by Tom and new co owned by Tom. Now the key thing here is they're associated companies, but they're not in a group, so therefore they cannot avail of group relief. If Pub 2 is transferred directly across to new co, you could have a situation where it's a disposal at market value. But because of the provisions or the interaction between section 587 and 615, and provided Revenue accept there is a bona fide reorganisation, well then what happens there is that this transfer can take place in a tax neutral manner. Pub 2 is transferred across from Alpha Limited to Newco, and relief is claimed under section 615 to the effect that no capital gains tax applies, and Newco acquires the same base cost for Pub 2 that applied to Alpha Limited. There also is another technical exposure absent section 587. The other technical exposure is that Tom owns assets, he has capital assets, he owns Alpha Limited, and in return for that he's got a valuable asset in Newco. So technically there's a capital disposal of his shares in Alpha Limited, but because of section 587 he's not regarded as having received shares in a capital payment in respect of his shareholding. So there's two reliefs there, 587 at Tom's level and 615 at the company's level. So now you have a situation that Tom owns Alpha Limited with Pub 1 and Newco Limited with Pub 2. What other taxes could be involved there? Well, there'd be stamp duty, but stamp duty relief is due. Newco will not have to pay stamp duty by virtue of section 80 because it was a reorganisation. What about VAT? Should VAT have been charged? Well, no VAT should be charged by virtue of section 35B3 because you've transferred a business. Now, on the face of it there, looking at that slide, it looks like a very, very generous relief. But there are certain conditions on it, and one of the conditions is that you cannot just transfer any asset across from one company to another in a situation like that. It has to qualify as being an undertaking. Now, what's an undertaking? An undertaking is a business asset or part of a business asset that can stand alone in its own right. So I've made it easy there saying pub 1 and pub 2. So pub 2 is obviously a business asset and it can be transferred across. For example, if instead of pub 2 it had been a residential letting, Alpha Limited would not avail of section 615 and it won't be capital gains tax. So bear in mind that it has to be an undertaking. So we've got all the reliefs across, and now we have Tom has shareholding in Alpha Limited and shareholding in Newco, and he can now gift or sell his shares in Newco to Anne, and he gifts or now sells his shares in Newco to Anne. What's the tax analysis there? Well, capital gains tax could apply at this level. Tom could be liable for capital gains tax on the gift or sale of his shares in Newco to Anne. But this is much more reduced capital gains tax than or tax analysis as previously if the company had sold its pub directly across to Anne. And this is important, Tom may now qualify for retirement relief on the transfer of his shares in Newco to Anne. So provided he's over 55, provided he's held the assets for 10 years, and bear in mind if he had a claim section 600 he could, and he held, when you take on aggregate his period of ownership as a sole trader and his period of ownership as a shareholder, he will meet the 10 years. His period as a sole trader will meet the 10 years requirement for a director. So if all those conditions apply, he's transferred the shares in Newco across to Anne. Now you might say, well, surely he hasn't held the shares in Newco for 10 years. But if it's a bona fide reorganisation, the shares can go across because it'll take its same level, a period of ownership as he held in Alpha Limited. So possibly retirement relief would apply. There's no VAT on sale of shares, so there's no VAT analysis needed. What about stamp duty? Well, stamp duty would be due here because it's post reorganisation, so therefore stamp duty will be due. And there's no blood relief due on shares, so 1% stamp duty will be payable by Arm. What about other taxes? Well, the other tax, if it was a gift, it could be capital acquisition tax analysis might be needed. And again, with capital acquisition tax, the period of ownership will flow from Alpha Limited, and Anne may now qualify for business property relief. So even if she's exceeded her threshold, you're probably assessable on only 10% of the value. That's 90% relief. So overall, if everything falls in place, little or no tax should be payable by virtue of 615, which is at the company level, by virtue of 587, which is at the shareholders level, and that was for the reorganisation, by virtue of 35B3 when Alpha Limited transferred its business over to Newco, that's the VAT exemption, and then stamp duty, no stamp duty on the reorganisation by virtue of section 80. So very little tax will be payable if it falls into retirement relief. Everything falls nicely in place for retirement relief, and everything falls nicely in place with regard to business property relief. So that's one of the most